how an unexpected outsider rewrote the rules. It began with someone the industry never saw coming. Not a banker, not an economist, not a hedge fund prodigy, just an outsider with no credentials, no connections, and no reason to be taken seriously. Yet within a few short years, this outsider would expose flaws that experts denied existed, then build a strategy that reshaped an entire corner of global finance. To understand how he did it, we need to return to a moment when the sector he entered was locked in tradition. The same institutions dominated. The same models drove decision-making. The same assumptions guided billions. Innovation was cosmetic. Risk was predictable. Everyone knew the rules because the rules had never changed. This story matters today because breakthroughs often emerge from people who haven't been taught what's impossible. Outsiders see differently. They question the assumptions insiders rely on. And when a system grows complacent, it's always the outsider who spots the cracks first. The first reveal begins with the outsider's strange obsession. He spent years studying the market not from the top down, but from the side. He tracked overlooked metrics, followed forgotten data trails, and focused on parts of the system considered too small to matter. While experts debated theories, he studied mechanics, the actual flow of incentives, biases, and errors baked into everyday decisions. The second reveal came when he identified a pattern others had missed, a recurring mispricing created by a decades-old process that institutions trusted blindly. It wasn't dramatic, it wasn't risky, but it was persistent and profitable for anyone who understood its rhythm. The outsider tested his theory quietly, using tiny trades, gathering proof that the inefficiency wasn't random, it was structural. The third reveal erupted when he scaled his strategy with a small group of independent investors. Their returns grew in ways traditional firms couldn't explain. Not wild gains, disciplined ones. Consistent, repeatable, proof that the stable market had a design flaw hidden in plain sight. And the moment they realized how reliable the pattern was, they understood they had discovered something much bigger than a clever trade. What they didn't know was that their discovery was about to collide with institutions determined to protect the old rules, no matter the cost. The outsider strategy grew quietly at first. His group placed small trades, measured outcomes, refined their timing. Each cycle confirmed the same truth. The inefficiency wasn't disappearing. It was embedded deep in the market's routine, sustained by habits institutional investors no longer questioned. What insiders saw as stability, he saw as blindness. But the moment their returns began attracting attention, the conflict emerged. Larger firms noticed unusual patterns in trade data, small but consistent profits accumulating in places where no one expected them. Analysts tried to reverse engineer the strategy, but nothing made sense. Their models couldn't detect the flaw because their models were built on the very assumptions the outsider had disproven. The first sign of resistance came subtly. A few brokers tightened access. A compliance team requested additional disclosures. Minor frictions, nothing more. But the outsider recognized a pattern. The system was becoming aware of him. And systems, especially those built on reputation and hierarchy, do not appreciate reminders of their imperfections. As the outsiders group expanded, their success created ripples others couldn't ignore. Their trades affected pricing moments earlier than before. Their volume, still modest, became noticeable. And in an industry where information travels faster than truth, whispers began forming. Someone out there had found a loophole. The tension grew when a major institution issued a private inquiry to its trading partners, asking for details about unusual activity patterns. The request wasn't public, but it reached the outsider circle through intermediaries. It was a warning disguised as curiosity. The outsider pushed forward anyway. He refined the strategy further, incorporating behavioral triggers and micro-level timing signals. His method didn't rely on prediction. It relied on understanding how institutions repeated the same mistakes day after day. As long as humans preferred comfort over change, the flaw would remain. Then came the breaking point. A large firm attempted to replicate the strategy, deploying significant capital to overwhelm the inefficiency. But their size, once an advantage, became their downfall. Their trades distorted the signals the outsider used. Their presence disrupted liquidity. Instead of closing the loophole, they amplified it. The Outsiders Group capitalized instantly, earning their strongest returns yet. That success triggered outrage behind closed doors. Suddenly, larger institutions saw the outsider not as an anomaly, but as a threat, a reminder that their assumptions were outdated, their systems fragile, their dominance vulnerable. And fragile systems don't adapt gracefully. They push back. Compliance requests turned into formal investigations. Brokers tightened access further. Rumors circulated that regulators might intervene. It didn't matter that the strategy was legal. What mattered was that it exposed cracks no one wanted acknowledged. The outsider realized he was reaching a threshold. His discovery was too big to stay hidden, too disruptive to remain tolerated. Either he would adjust, or the system would force him out. He chose neither. Instead, he prepared to confront the system directly, because for the first time, he understood that the inefficiency he exploited wasn't an accident. It was a symptom, and symptoms always point to something deeper. Inside the industry's inner circles, suspicion turned into strategy. Meetings were held to discuss market distortions. Reports circulated claiming an unnamed group was manipulating price signals. Thinly veiled references to the outsider's operation. Journalists caught wind of the tension, publishing speculative pieces that only intensified scrutiny. The outsider's anonymity evaporated. The system now knew who he was. But instead of panicking, he dug deeper into the very flaw he had uncovered. He realized the inefficiency wasn't simply a quirk of market structure. It was the byproduct of a legacy process built decades earlier, a process now misaligned with modern trading behavior. Institutions had grown around this flaw. They optimized everything except the foundation. And that foundation, cracked and outdated, was the reason his strategy worked at all. The conflict sharpened when he discovered internal memos leaked from a major firm. They confirmed his suspicion. Executives had known about the flaw for years. They tolerated it because fixing it would require rebuilding their systems from the ground up, an expensive, politically messy overhaul. It was easier to ignore the problem and hope no one ever exploited it. But now someone had. Pressure intensified from multiple directions. Regulators requested data from brokers. Compliance teams at trading firms began targeting any strategy they didn't understand. Brokers threatened to terminate accounts under vague risk concerns. It was the industry's classic defense. Overwhelm the outsider with bureaucracy rather than confront the truth. The outsider refused to fold. He gathered evidence, trade logs, timestamps, liquidity data, and mapped the inefficiency with forensic clarity. He built visual models showing exactly how institutional habits created the flaw, how the flaw shaped the market, and how his strategy merely exposed behavior the industry had buried for decades. Still, the pushback grew harsher. A powerful institution quietly restricted access to a critical data feed his strategy relied on. Another modified order routing procedures in ways designed to distort the signals he used. At first, these changes weakened his returns. But then he noticed something surprising. The new distortions made the flaw even more unstable. The industry wasn't fixing the system. They were panicking inside it. The turning point arrived during a high volatility week. Market stress amplified the inefficiency he had discovered, stretching it far beyond normal ranges. His models lit up with opportunity. Trades executed flawlessly. Returns spiked. His strategy didn't just survive the industry's resistance. It outperformed because of it. That surge caught global attention. Analysts noticed the anomaly. Independent researchers tried to replicate it. Financial bloggers speculated about a mysterious new method. The harder institutions pushed to silence him, the more visible the flaw became. By now, the outsider understood what he faced. A system built on old assumptions, protected by power, threatened by truth. The inefficiency wasn't merely academic. It was structural evidence that the market's foundation was outdated. And the moment markets realize a foundation is broken, everything built on top of it begins to shake. The outsider knew the next step would decide the future, not just of strategy, but of the industry itself. Would he stay quiet and keep profiting in secrecy? Or would he force the world to confront the flaw it had ignored for too long? He chose clarity, and the confrontation that followed would rewrite the rules of the game. He unveiled everything. Instead of locking his strategy behind proprietary walls, Instead of hiding from the pressure of institutions determined to silence him, the outsider published a full analysis of the flaw, openly, publicly, undeniably. He released charts, datasets, historical comparisons, and detailed explanations of how the inefficiency formed, why it persisted, and how institutions had unknowingly reinforced it for decades. His report spread across forums, research networks, and trading communities within hours. The market froze. Experts who had mocked him now studied his findings line by line. Academics validated his conclusions. Independent analysts ran their own simulations and reached the same result. The flaw was real, structural, and far more consequential than anyone imagined. It wasn't a trick or a loophole. It was a mirror showing the industry what it had refused to see. The climax erupted when regulators launched a formal inquiry, not against the outsider, but into the institutions that had allowed the flaw to exist. They demanded documentation, system histories, error logs. They questioned why billions had flowed through outdated processes. Legacy firms scrambled to defend themselves, but their explanations, once persuasive, now sounded like excuses. Markets reacted immediately. Strategies built on old assumptions cracked. Traders adjusted models overnight. Firms that ignored the report faced volatility they couldn't explain. Meanwhile, the outsider's blueprint spread globally. Small investors used it to understand behaviors they once found mysterious. Innovators began building new tools around it. Engineers used it to design smarter, cleaner infrastructure. The industry had no choice but to adapt. In the weeks that followed, major institutions announced reforms. Updates to systems they had insisted were flawless. Revisions to processes they once claimed were essential. Upgrades they had postponed for years. What began as resistance turned into reluctant acceptance. But the most profound change was philosophical. Leaders started questioning traditions they had blindly trusted. Analysts re-examined metrics taken for granted. Firms encouraged experimentation instead of conformity. The Outsiders Act hadn't just exposed a flaw. It had reignited curiosity in an industry that had grown complacent. The resolution came quietly, in the form of an invitation. A global regulatory body asked the outsider to join a task force to help rebuild the very systems he had revealed as outdated. He accepted, not for recognition, but for purpose. He hadn't entered the market to break it. He had entered it to understand it. And understanding, he proved, can be the beginning of transformation. His journey left behind a message that echoed across trading floors and boardrooms alike. Systems fail not because they're flawed, but because people stop questioning those flaws. Outsiders matter because they remind the world that progress begins wherever certainty ends. Sometimes the smallest shift in perspective becomes the beginning of a new future.